Hi, my name is Christopher Terry, CEO of iMarkets Live, and I want to welcome you to our webinar. Before we get started, I want to get a little groundwork. I'm going to open up a screen, and this is going to show a YouTube video. Now, right at the bottom right of your screen where it says Settings, click on that, either go to HD or Auto, and then reset the video back to the beginning. When you do that, it's going to update the video to have a very clear picture. The other thing you want to do is click on this button right here and make it full screen, and that way you have the crispest, clearest picture and you can see the video as best as possible. Let's get ready. My name is Christopher Terry. The idea of iMarkets Live came from over 14 years of retailing my educational services and mentorship in partnership with other expert traders. This produced some of the most successful and recognized traders and analysts throughout the world. iMarkets Live is a system of products which now allows virtually everyone to become a successful trader. I'm living proof that there is a better way than what you are doing right now to create real wealth. I feel blessed to be able to bring to you these products and opportunity to meaningfully change your life for the good by merging of two powerful industries. A little bit about myself, and then we're going to proceed and go through the webinar on Forex and futures, but it's important for us to let you know who's educating you. My name is Christopher Terry, as I said earlier, and I've spoken for numerous derivative conferences, private events. I've been in numerous magazines. I'm asked to speak throughout the world. I've traveled to many, many different countries educating. I've been in books and magazines, and it's my blessing to be able to share this and help educate others. I've been interviewed for big websites such as Optionetics, written articles from magazines. Some of them have been put into books as chapters. On the back of our website, inside for our members for iMarkets Live, we have multiple articles that I've written for various magazines. I've been in numerous books of people that I have mentored, and also people that are in the industry that had asked me to give a quote or had cited some of our work. Here's a book by Adam Grimes, a friend. The Art and Science of Technical Analysis, and he included me in his book along with a lot of big market wizards, people with major names in the industry, and I was fortunate enough to be put into the book with him. There's another gentleman by the name of Brett Steenberger. He's a phenomenal educator, psychologist in the markets, and very well respected doctor. In his book, Enhancing Trader Performance, he had asked me to do a quote for him. In the book Trading Full Circle by J.U., who is a former competitor of mine, he asked me to give a quote when I was back with my old company. There was a book written and published by Bloomberg by two people, and they had cited some of my work, which is basically coming out of the Stocks and Commodities magazine. So they had included in their book. I've written 2 chapters for multiple books, and this one was called The Dow Theory, and it was in a book from SFO called Technical Analysis. And they produced a second book on the psychology of trading, and I put an article which became a chapter in the book, Defining the Trading Game. And last but not least, we have partnered up on the educational side with one of the largest educational platforms, brokerages in the planet, Ninja Trader, and we're part of the ecosystem. And at the time of this taping, this is a recent press release. Basically, they are excited as we are that we've joined hands in educating people about becoming traders. And as you can see here, we have a lot of information that we do, and it's just absolute blessing to be able to bring to the public through Ninja Trader and iMarkets Live our educational services. And let's get on to the webinar. In this webinar, Market Geometry Using Time and Price Patterns, we are going to discuss A to B, C to D relationships. We're going to discuss harmonics. We're going to discuss price clusters. We're going to discuss Fibonacci ratios, and we're going to get into some advanced market geometry using time and price patterns. Now, this webinar is not for a new trader. It's not for the newbie who's looking to get information on the markets. This is a webinar that is for an advanced trader, somebody that has some experience in the market, that understands Fibonacci, that understands a little bit about price patterns and trends or Elliott wave. This is a webinar that takes all of that into consideration. So this is more or less an advanced webinar. So if you're not at the right webinar, please, this is not for you because you may get bored. All right, but let's get going into the webinar and start discussing market geometry using time and price patterns. What we're going to do is, as we progress till around the middle of the webinar, right before we start getting into the last section, it's broken up into a few sections, but right as we get into the middle to end of the webinar, I'm going to show some of our services at iMarket Live. I'm going to go iMarkets Live. I'm going to go through a little detail about what we do, the different services, take a little commercial break so you're not shocked that I pick it out in the middle of the webinar. And then we'll go through and completely do a pattern from scratch. You're going to love what we do. This webinar has been done for audiences around the globe. I've had massive excitement about it, and a lot of people have asked me to do it. So I'm putting it into a video format for those who are taking the step to get more information about iMarkets Live and what we do. So let's get rocking and rolling. Get right into the video. Okay, what we have here is what they call an A to B, C to D relationship. They have impulsive, which is in the direction of a trend. A to B, as you see, and C to D is in the direction of the trend. We also have corrective, A to B, C to D. So if somebody says to you, we have an A to B, C to D relationship, you have to question, is it impulsive or is it corrective? And impulse is in the direction of the trend. Corrective, as you see here, both on both slides, is against a trend. It's what they call a pullback or a secondary correction. In the Dow theory, this is called an intermediate segment in the direction of a primary wave, and the correction here would be a secondary trend. So in more of an Elliott fashion of what they call an alternate wave equality, you have your A to B, C to D relationship. And as you look forward into this, typically an A to B, C to D would have an equal swing or a measured move is what they call it. So you want to keep that a little bit of a note that we're going to get into. So I'm going to throw some examples up here. Is your A to B, C to D relationship, as you see here on this particular chart. This is the S&P E-mini futures, and this is a corrective A to B, C to D relationship. If you start looking at your charts, you'll see little areas. For instance, this little swing here and this little swing. Those are little A to B, C to D relationships. Little one right here is an A to B, C to D. So you can have swings within swings, corrections within corrections, something to keep a note on as you progress on this format. Price relationship, another one, A to B, C to D relationship. Now I'm going to drive them home. I'm going to show multiple examples until you understand what I understand, at least at the basic level of how to put this all together. So you have price swing down A to B, and throughout this trading range, you had another large swing down. A flush, as you see, came right into around that same zone and gave that C to D relationship. A lot of traders would look at this and say, okay, as soon as it hits this equal swing, this is an area to buy. You see how that can be determined? You have your A to B when the prices move down roughly to an equivalent swing. You look at that as a buy. You put your risk against the prior swing low. That's one way to look at it, but in terms of patterns, that's your A to B, C to D relationship. Okay, here's another one on slide 5. This is an A to B, C to D relationship. The market's correcting. We can also look at this as a high, an A, B, C corrective wave before the trend continues higher. It's also called an A to B, C to D relationship. Here's another example of a corrective wave. You have your A to B on this trend, and the trend's moving itself up. And you can see along the way, you have other retracements of the little A to B, C to Ds. But when you're looking at retracements, you take the last largest swing and you look at the next largest swing, and that's where that comes into play. So you have your A to B, C to D relationship. And this is on the AUD, CAD. I just picked out any random market just to point it out. But you can have swings. Like for instance, this swing right here is an A to B, and this is a C to D swing within the context of the larger trend. So you have swings within swings, but you always look at the last largest swing for patterns. And here's another one. This is more of an impulsive A to B, C to D relationship. Market swung up X many points, had its retracement, its corrective retracement, and then another impulsive move up, where it hit around 100% of the same swing of A to B, and now it becomes a C to D, a one-to-one relationship. And here's another example, and we're going to continue to look at this, and we're going to drive it home. Is your A to B, C to D in a direction to the downside? A downtrending market also gives that 100% equality move where prices stop going down. Now, is this going to happen every time? No, there's other factors that come into play, but I want to point out different things to look at in the pure price action of A to B, C to D in a perfect world, in a perfect example. And then we can look at other things and relationships and derivatives of these A to B, C to D relationships. But we're just getting the basics and training our eyes on what to look for. Now, we're going to start looking at the Elliott wave concept. The Elliott wave concept. And in Elliott, typically you would have normally a 5-wave up. In a very, very strongly trending market, you can have 7 or 9 waves up in a very strongly trending market. And in this particular example, what we're showing here is the Elliott wave, but yet from the 5, you have that A to B, C corrective wave. And those of you who know Elliott wave, you would understand this. We're going to go through a little bit more in detail so you understand the basics for those of you who do not understand it. Those of you who understand harmonic waves or harmonic patterns would understand looking at this as a possible Gartley pattern or any other harmonic pattern. We're not going to get too deep into that, but you can see the structure is there for a harmonic pattern or an A to B, C to D relationship, which in the Elliott world, it's a high or a 5, and then that A to B, A, B, C down. Now, each of the waves, 1 to 2, 3 to 4, one of them will have a sharp correction, and one of them will have a complex correction similar to the 5 high with the ABC down. So for instance, if 1 to 2 was sharp to the downside, 3 to 4 can be expected within the 3 to 4 wave to have a little corrective wave similar to what you see on the 5, which is on a much bigger scale. After the 5 wave, you get a bigger correction, but the same thing happens within the context of these other swings. So 0 to 1 will have 5 swings up. 1 to 2 will have sharp, and then 2 to 3 will have 5 swings up, and then 3 to 4 possibly that ABC corrective wave, and then 5 swings up into the 5th wave of the larger trend, or that would be the 5th wave of the 5th wave essentially. And then you'll have your larger retracement. So something to keep note of. Now you're looking at what we call retracements. I want to look at a little bit at retracements, extensions, projections. I want to look at this to get us all on the same page. Retracements, what that means is take your low to take your high. From the high down, we typically will see 3850, 618, 707, 786, and 886 retracement. Those of you who are familiar with Fibonacci understand what the 382 and the 50 and the 618 is. The 707 has to do with a square, or the diagonal of a square. The 786 is derivative or a square root of the 618 ratio, the 886 is the square root of the 786. This is all based on what we call phi, PHI, or phi, PHI, depending on how you say it. The 618 is small PHI, where a 1618 has a capital PHI, and that's the inverse of the 618 percent. We also know that a low to high and a retracement from 38 to 50% is considered a shallow retracement, and that happens in a very strongly trended market. A lot of times off the market low, before it really takes off to the upside in what we call an Elliott 5 wave, you may see a deeper retracement where it goes from A to B down as deep as a 618 to 886 before a higher low is put in, before the larger trend starts to take off. The markets never go straight up. They have to make a retest down. A retest means you take from the high down to the low, and the higher low has to be put in, and then a higher high has to be put in. So before the market can reverse trends, a higher low has to be put in at some point, a failed test of the low, which means it doesn't make a full test, comes in. So this is what we look at in terms of retracements. The inverse is correct for a market coming on the downside. So the Dow theory says the market will retrace 1/3 to 2/3 of its original gain or loss, many times stopping at 50%, and then many times completely failing it altogether. I do suggest reading the Dow theory. It's in Edwards and McGee's book. I think it's Trend of the Stock Market, the technical analysis and trends of the stock market. It's called Edwards and McGee. It's one of the books. The other one's from Shabaka, which is considered the Bible of technical analysis. Now, in a very strongly trending market, in a bull market, typically made of 5 waves. However, as I said, in a very strongly trending market, there can be 7 or 9 waves. And the reverse is true in a bear market. A market can continue to trend and trend. There's a saying in the Dow theory that says a market will continue to trend until a reversal signal has been definitely indicated. And a lot of people in the Elliott world read into the fifth wave, and they look at the fifth of the fifth, and they look at these waves, and they don't take in consideration the strength of a trend. And that's important. So being a technical analyst, being a tape reader, a chart pattern reader, you always stick with the trend until the trend has definitely signaled a reversal signal and starts continuing in another direction where you have confirmation. So for Dow theorists, you basically have your strength in a particular market right there in that trend. So here's how a typical 5 wave and an ABC corrective wave looks like. I'm not going to get into how many waves and based on fibs. I'm looking at something completely different here. I'm looking at the market structure. I'm not looking at other things that have to do with Elliott, and that's a completely separate webinar. So waves 1, 3, and 5 are impulsive. So 1, 3, and 5 are impulsive, and waves 2 and 4 are corrective. So here's your second wave, here's your fourth wave, they're corrective. Impulse waves determine the trend and contain a minimum of 5 waves. So in this direction, this is an impulse wave to the upside. Corrective waves normally contain 3 waves. Sometimes one sharp wave will complete the correction. As I said earlier, from 1 to 2, you may have a sharp move down, or you may have it on a 3 to 4 wave. One or the other may be sharp, and the other one will have that corrective feature. So as I said earlier, if you recall, that 3 to 4 wave has that little ABC within the structure or the equality of the length that the 1 to 2 had. Once the 5th wave is complete, and as you see here, first wave is complete with 5 waves, third wave is complete with 5 waves, and the 5th wave is complete with 5 waves, and that ends the larger 1 wave up, which you'd see here. See that? So if we expanded that to a much bigger picture, this would be the same thing. And then you're looking for that bigger ABC corrective wave, which you had saw on that 3 to 4 wave. So having that, now you're looking at a much deeper move down after the 5th of the 5th, Although you're looking at a larger term corrective ABC, the first swing down, which is possibly more than the prior swing, will have its own 5-wave down, 3-wave up, 5-wave down to complete the larger ABC down. Wave 2 to 3 is the largest wave. From 2 up to 3 would be the largest wave in a trend. This is why we look at the number 2 wave for that failed retest, that higher low. It may come in down here, it may come in here, but this is just for illustration purposes. Once that higher low has been established, that's when all the big bulls jump on board before the general public even knows it's happening, and or general traders know what's happening. It starts expanding rapidly to the upside, leaving those who were not privy to this, or leaving those who are still looking for a move down in the dust. And by the time it gets up here, guess what? It's gone, and then everybody starts to chase it. So wave 3 to 4 never goes below wave 1. 3 to 4 is right here. It never comes below this wave. If it does, then it's a failure of that particular pattern. And then 38% from 2 to 3, it never corrects more. I typically like to see 38 to 50% above the wave 1. So anywhere in that zone, I typically would look for an opportunity to enter. Once you have everything correcting on your A to B, C to D relationship, or ABC corrective wave, plus your retracement, plus, you look at price structure, and that's where we look at patterns and how we work it in the Elliott world. Now, example here, what we call an alternate wave equality, 1 to 2, 3 to 4. 1 to 2, 3 to 4 are pretty much equal. As we said, sometimes you'll have a sharp 1 to 2 or a sharp 3 to 4. The other one will have their complex correction. But you want to look at what we call alternate wave equality, length of swings, length of relationship. Same as you have a 1 to A and a B to C typically will be wave equality. They would have the same type of correction. Now, Elliott wave 5 structure Fibonacci retracements 0 to 1 to 2. 0 to 1 to 2, you'll typically get a 50 to 618 retracement. Sometimes it'll go deeper. It's not limited to that. It's not an exact science. It may go deeper. Now, if I'm going too fast for you in the video, it's because some of you may be advanced and you're getting it, and some of you may take some time to get it. But I'm giving you all the information you need. You could always rewind the video and watch it again. Otherwise, set it to slow motion. So we're going to continue here. That 1 to 2 versus the 0, you'll get that 50 to 618. You're always looking for that higher low to end the trend. Once you've established a fifth or wave down into your 0, and that's ended, now you're looking for a reason of shift in momentum from the market to go from down to up. In the wave 2, 3, 4, which is from 2 low, 3, and then 4, I'd like to see a 38 to 50% retracement. So that's how I look at structure. I also look at that 3 to 4 to equal that 1 to 2 within reason. What does that mean? So let's just say 1 to 2 is 10 points. 3 to 4 can be a 618 to a 1272 extension. So it may be 6 points to 12 points, but it also may fall within the 38 to 50% retracement zone. So you want to make sure things match up. And this is where trading is both an art and a science, and why traders tend to enter early, and as the market gets its true correction, the traders get stopped out before the trend continues. Have that ever happened to you, where the market suddenly, you get in, it goes too far, you get out, it scares you out, and then it goes in the direction? That's because you're not looking at the equality of prior waves, the relationships, the Fibonacci retracements, and such. So keep that in mind. The next one, we're looking up at what we call a 5-wave with an ABC corrective wave. Here's your 0 at the low. The market rallied. It took a little time. You see this, not pretty, but it made a low to 1, a 0 to 1. Now that came all the way down between a 618 and a 786 retracement, the higher low. Remember the higher low that we discussed. You're always looking at prior swing highs and lows also. or what we call market structure, you always want to look in the past to see what had happened, swing highs, swing lows. Most important things to pay attention to. And in those who like to read price, you could just look at these swing lows down here. So the market did its retracement and then started its journey up. The next large retracement, as you see here, within reason of percentage, and markets will relate in degree depending on the length, depending on the time frame and the market. So in this case, you had your 1 to 2, 3 to 4, and then you had your rally to your fifth wave before having that ABC. As you notice, the 2 to 3 swing was the largest move within the whole structure of the 5 wave. Once your B made its ABC down, that ended the correction before it continued higher. And it started a whole new set of rules. The market actually went to over 2,000 after this particular correction down. So something to note. You have your 5 wave here. In this example, this is the EURCAD, and we got multiple examples. What I want to point out is first, your 5 wave, your 0, 1, 2. Now this had a shallow retracement. When you have a shallow retracement, that's extreme power in the market. Extreme power. They are not letting anybody in to buy at lower prices. The market has shifted, and you have such a strong impulse bar that the market is making such a shallow retracement. You get your little ABC corrective wave. That's telling you that there's extreme power to the upside. That's one where you expect in the next wave to explode. And this does. It goes from 2 to 3. Now remember what we said in the past. You're either going to get an ABC corrective wave or a sharp wave, or they're going to alternate. Well, in this example, 3 to 4 was a sharp move down. You see that? That was a sharp move down. It went about 50% of the prior swing. That's acceptable. Price also was deeper than the 1 to 2. That can happen. Although it may look here as it's much greater. Well, this 1 to 2 right here may have a relationship. Maybe this was 10 points and this was 12 or 16 points, or 1618 extension of this prior swing. So you have to always take that in consideration. As I said, the market, you have to look at how things match up. The prior swing to the prior swing with the 100%, 120%, 7%, 160%, along with the retracement of the prior swings. That's what we look at when we're trading. And although it's a little bit tough in the beginning to do, that's what you have to do to identify swing lows and swing highs. So here is your 5 wave up on the EURCAD. Now we look at time ratios. And essentially we take swing lows and swing highs and we match them up. We look at 0 to 1, 0 to 3, 2 to right here, 0 to 1 equal 2, 0 to 3, 0 to 2, 1 to 3, 2 to 3 as an example. And we look at where clusters, where matching comes in. For instance, from 0 to 3 may have a 24% extension, where 1 to 3 may have a 38%, or 2 to 3 may have a 50%. We look at all these different swings and relationships to determine swing highs and swing lows based on the prior swing highs and lows. So not only do you look at Fibonacci in terms of price retracements, you look at it as in terms of time also. If the market went up in 10 days and it corrected in 3 days or 4 days, the next swing up may have gone 8 to 10 days also. The next move down may come in that same 3 to 5 days. You follow? So you're always looking at relationships in terms of time, low to 0 to 1. How long did it take? How long is it going to take from 1 to 2? It can take about 24 to 38 or 38 to 50%, depending on the market, depending on the speed of the move. Very important is time ratios, more important than price, believe it or not. Gann made a big deal about this in his book. Big deal about time being the main factor. As an example, if time went here, say twice, and it corrected 5 days or 10 days, let's just say 10 days, and that's actually what it said in his book. If it corrected around 10 days, say twice, the next time it corrects goes not 10, but 12, 14, 15 plus. That is telling you that the trend potentially can be changing from what we have seen in the past because time has changed. So time ratios, same as Fibonacci price ratios. Elliott wave, the 5 wave. We're going to look at this further. Now, sorry about that. I went too far into a slide. So we're looking at projections. Projections are A to B, C to D. We're projecting from A to B, C to D. So if A to B was 10 points, a 1-to-1 relationship would be 10 points from C to D. That's a projection. If resistance is up at D, up in this area, and the market went up 10 points from A to B and then C to D had a major resistance around 16 points, well, if you look at it, that would be a 1618 projection from A to B. If resistance was down here and was a 786, you would have 10 points from A to B and yet around 7 to 8 points on that C to D and still stay within the context of an A to B, C to D projection. Extensions. Extensions are taking B, C to D. B, C to D. So B being, we'll use that 10 points again, 10 points from A to B, B to C, up as an extension, a 1272, that would give you 12 points on the way up. For instance, if it was a 200% extension, it would be 20%, 220 points on the way up. Here's the example of an extension. So you have retracements, projections, and extensions. Let's look at commonality zones and how this all starts to work and make sense. You have a big graph here. We're going to break it down. We take the low to high. Then we make a higher low, L1, higher high, H1, higher low, L2, higher low, higher high, H2, higher low, L3. L3 is diagrammed right here and in detail above. What we like to do is we take the higher lows, either from L, L1, L2, and we throw retracement levels. You may have a 38% retracement from L, 24% retracement from L, a 38% retracement from L1, 50 or 618 retracement from L2. And it starts to leave a series of lines or retracement levels, a zone, what we call commonality. You may hear it as clustering, basically looking for zones that tie in together that are very tight in terms of retracements. We also then look at the high ABC down and we look at the projection. Remember what we just looked at? H2 down to A, let's just say that's 10 points. Well, from B to C, we look at roughly the same, or a percentage of it. That would be a projection from H1 to A and from B to C. We look at the extension from A to B. A to B goes up 10 points, maybe B to C goes down 12 to 16 points, or 10 points. When you're looking at this, when you're putting everything together, you're laying out your retracement levels, you're laying out your projections, your extensions, your relationships, and you're looking for a zone, a cluster zone, a commonality zone where we could identify a key support or key resistance area where price is going to turn, and that's what we look at. We also overlap that with our time ratios, as we mentioned, where we have clustering, time and price, time and price. In what we have here is the commonality and harmonic, basically almost the same thing. So you have your Dow theory, your retracements, you have your Elliott wave, your retracements, your harmonic patterns. So at A to B with the retracement to C is essentially that Elliott 5 wave up with that ABC corrective wave, or what we call an XABCD in the harmonic world. This could be what they call a Gartley pattern. A Gartley pattern would have your A to B down to 618, up 38 to 88%, and then the C to D down, and that X to D is around 786 of the whole structure. So you could see how they work together. You have your commonality zones and your harmonic patterns tying in together. Real important, because a lot of times your Elliott people, your harmonic people, and your price action people, meaning your Elliott's, your Dow theory type people, your basic technical analysts who look at bull and bear flags, continuation patterns, your harmonic people. Everybody looks at different things, and they don't want to go into the other side. They don't want to venture into the other person's territory. I say venture in and put this together, and it would make more sense, and it will keep you on the right side of the trend each and every time. And when you do fail, you're going to fail at a very small percentage of times you attempt this. Now, like I just said, if we take on the left that typical retracement, and on this right, it's the same retracement, same length, but if you look at the breakdown, you have your Gartley pattern. You also have your Elliott ABC corrective wave. So you have your XABCD or your ABC corrective wave, or your what we call a harmonic pattern within the context. So it's a bullish harmonic pattern with structure within the bullish pullback regardless. You understand? So let's take a few minutes out and let's just discuss what I do, what we do at iMarkets Live, how it benefits you, and then we're going to continue to complete our section, and we're going to put together a nice pattern. I'm going to get into some good details that's going to make a lot of sense to you, that's going to take your work to the next level. But in all fairness, we're giving you content. We want to share what we do, because if you like what we do, if you like the ideas that we presented to you today, we would hope that you would either A, get more information, B, become a customer, C, take a test drive, take a 14-day test drive, or become a customer, or refer us to other people. Right? There's no hard sell here, but we want to share quality content, but we also want to take a bit out for our little quote unquote commercial. So the educational services we provide for those who are interested in it is you could watch us live in where we have a live trading and educational room. We have it on an HotCom platform where we look at live patterns, technical analysis. I'm doing these patterns day in and day out. I'm doing them live. I'm doing them on through early in the morning to late in the afternoon, and essentially you're looking over the shoulder with our live audio, video, and text room. You can type in questions, you can ask. We'll show you what we're looking at. We can go over charts if you need to. We point out ideas throughout the day, and also we do this on webinars. We do the same format in webinars in our live. What we have here, and this is for people that want to learn throughout the course of the day and just get ideas. You may not take our ideas. You may say, you know what, I just want to know what direction of the trend you're looking at so I could work in that direction. You may look at us for ideas of support and resistance, say, you know what, as soon as you call support, I want to take a scalp. I've been doing this particular model as of 2014 for over 14 years, 15 years to be exact, doing this particular model. My prior mentor, my prior partner and I, we did this for nearly 13 years together. I took and I went on my own to do it, and it's been our fabulous product. We added what we call a signal service. It's a hand-free signal right down here. And essentially, we send a strategy signal from our end, and it's modeled around the live trading room. What that means is for the live trading room, we may call a buy or a sell. Well, what better than being a live educational member to get a signal that we do on our end? We press the button when to buy, and the signal sends a strategy to your platform. It could be a demo platform, it could be a live platform, but let's just say it's a demo platform or a practice account. We say it's a buy, and we send the signal and we buy. We essentially are showing you on your own charts our confidence when we buy and sell and how to do it. The biggest thing for a new trader is that, or a trader, is the confidence level, and we build your confidence when we buy or sell because we're showing you exactly when to get in and get out rather than you have to wonder if we're in or out. So the two work together. We created a separate model, a separate standalone product, which is that signal service. And that's for people who maybe you're just busy at your job all day. Maybe you're busy at a business. Maybe you're on vacation. Maybe you had to leave the live trading room halfway during the day. You could turn your signals on and it would automatically, within a fraction of a second, when I send a trade and you're plugged in, you're connected to our server, and our system takes like 5 minutes to install. It's really simple. Soon as we hit buy or sell, it sends a strategy and executes on your account. Now, I want to be upfront. We do not have any broker commission relationships. We do not involve ourselves in your account. We do not trade your account. We do not pick how big your trade size is going to be. We have no idea if you are live or not. All we are doing is sending a strategy signal, and your account sees the strategy as a signal to buy or sell. And we put in our stops, we put in our profit targets, we manage it. And this right here is being used by people around the globe. We have thousands of people around the globe looking at our charts all day, using our signal in over 60 countries. It's exciting, it's viral, it's unprecedented. For those who want to work 1 to 2 minutes per day, here's the business for you right there, signal services. Those of you that want to just learn, our live trading and educational room and webinars. And the last one is those of you who are traders, those of you who want to execute, but you don't want the signals to do it for you. I set up a special signal called the trade alert signal. It's a self-managed signal. I send it in an email. It's on a larger time frame. And when you get it, you have your entry, your stop, your profit targets all included on the chart. And you do the entry. You do as much as you want or as little as you want. And we typically do that on the Forex markets. And we do everything here for Forex and futures. Let's go to the next slide. I'll show you a couple of things and we'll get back to our regularly scheduled webinar. This is what our live trading and educational room looks like. You would literally look at my charts all day long. I have 6 screens that are showing charts. I actually have 10 screens, but we're showing, I'm sorry, 8 screens that I'm showing you, but I have 10 screens, and I'll show you something at the end that's real exciting. Right here is our live trading and educational room. It's just a picture, and that video is live throughout the course of the day, and you could type in questions and watch and listen to what we're looking at live, why we're buying, why we're selling, why we're taking trades, what we're looking at exactly in what market, and the reasons. It's exciting. It's a phenomenal product. It is a 15-year-old successful model. The next example is what we call our hands-free trade signal service. And here's an example on the left of the client. On example of the right is a master. And these are up on what we call a virtual private server. A virtual private server is essentially a computer in the cloud. So I put them both together, as you see here. And the top one is the S&P E-mini futures. The middle one is Forex, which is the AUD and also the EUR USD, as you see on the left. And the bottom one is the Forex futures. What I did was, as an example, I sent an alert, just a test, where we did a trade for each of them on the master. And on the left, instantaneously, the trades show up on the client side, and they can see that they're in a trade. So we manage everything from the master. We send all the stops, all the targets and everything onto the client. As long as the client is plugged in to our server and the master is plugged in, guess what? When we alert, you alert. When we alert, you alert. It's that fast and that amazing. So we look at multiple markets and we're able to trade. And let's just say you're on an airplane. Here's the cool thing about what we have. Our client side, we typically use a VPS. So that means if you're in New York, and right now we actually have somebody at the time of this taping, a gentleman went from New York to Hong Kong. His VPS was set up in New York, his platform was set up in New York, his trades, and he went to Hong Kong. When he went to Hong Kong, he logged in to the same exact VPS he had when he was in New York because it's in the cloud. And his platform was set up, and when we did trades, he got trades. So he created a profit while he was in the air on his way to Hong Kong from New York. It's absolutely unprecedented, amazing. And I can't say enough about it. This is a phenomenal, phenomenal product I've had for a very, very long time. And here's another example of what it looks like on the MetaTrader. This other one was on the NinjaTrader, which is our phenomenal, phenomenal package. By the way, NinjaTrader and iMarkets Live are educational partners. We're not broker relationship partners. We're partners on the education side. So we created great synergy with them, and they allowing us to teach and upload YouTube videos. And here's MetaTrader 4, same product. Those of you that like MetaTrader 4, we're going to be adding this back in. We had it for a while, we took it off, and it's going to be coming back into our platform after October 1st. So if you've seen this video after October 1st, you would have it already. If you've seen it before October 1st, it's coming. We're going to be setting it back up. So you have your master and client basically also on the MetaTrader 4. And as soon as we execute, it executes on the client side and on the master and the client side. Now, what's great about both the NinjaTrader and the MetaTrader, no matter who you are, where you are, you could determine your trade size, meaning that we send a trade at the lowest amount possible, so in case somebody makes an error. But you can determine how big your trade is going to be. For instance, if we send a signal on 1,000 lot position and you wanted to do 10 times one standard, 100,000 or 10,000, I'm sorry, or 100 times 100,000 lot position, you can do that. So we have the flexibility handed to you how big or small you want to trade. And also we have the opening play video. Each morning I send out a video and it goes into the back office of the members and it goes to your email. Basically what I'm looking at the next day, I'm looking at patterns, I'm drawing out the patterns, the analysis, and I've been doing this since 2005. I've been doing this, actually 2004 and a half. Been doing this. It's a favorite product by a lot of people who don't need the trade signal service, who don't need the live chat room. They just want to know what we're looking at for the next day, a game plan. So those of you that just want a game plan, this is a phenomenal, phenomenal product. The next one is that self-managed trade alert, where we send out a chart. This is an actual chart, whether we exited or not afterwards. I believe it went up a little bit at the time of this taping. The point is we send out the chart, the pattern that's involved. We look at the reasons why we buy or sell, and we send out a signal, buy, stop, targets, and you can manage it on your own. This is you entering, you exiting, you managing, but us giving you the idea. This is for the trader who is a good trader. They just want additional ideas. Whether they take it or not, it's up to them. And let's get back to our regularly scheduled program. We got some more stuff to talk about at the end, some cool things. So we're going to go through and discuss a couple of things. We have the Gartley pattern, for example. X, A, B, C, D. X to A down to B is typically a 618 retracement. From B to C is 38 to 88% on the way up. And the X to D area from A is 786 roughly in terms of retracement. Now there's deviations of this. There's the bat pattern, there's the butterflies, there's crabs, there's other X, A, B, C, D patterns that as long as there's binding geometry. What do I mean by binding geometry? It may not fit within the criteria of the well-known patterns like a Gartley, but yet it has market geometry and relationships from the XABCD in the prior swings, which to me still work. There was a gentleman, his name was Bryce Gilmore. He's now retired, and he's somebody who I have followed over the years. Him, Larry Presavento, there's Scott Carney. There's a host of phenomenal people that were pioneers in this industry in terms of the harmonic patterns. And I suggest you look more into it. And we provide this on a day-to-day basis anyway. Our swing trade alerts, our opening play, our live trading, we show this, we draw it out, and we teach it. So what we have going forward is something we actually do on a daily basis. Looking at a chart, you just have your basic swing highs and lows, and it doesn't really look so much as anything. Well, we're going to start putting together a pattern and what I look at and how we look at it. The next swing, next page is you have your 0 to 1, 1 to 2, 2 to 3, 3 to 4, 4 to 5. Your 5 wave down. Is it clean? No. Is it a 5 wave down? Yes, it is. So you're looking always at patterns and waves. You want to know where in the pattern you are. Although this 3 to 4 was wider than the 1 to 2, two things happened. The 1 to 2 was sharp, where the 3 to 4 wave had a complex pattern. And if you're looking at the complex pattern, you actually had an A to B, C to D relationship within that complex pattern. You also had ratios. So this 3 to 4 is a derivative of the 1 to 2. It may be a 1, 6, 1, 8 of that swing, but yet it held binding geometry from the ABC up and also from 2 to 3 up to 4. From that, the market shifted its momentum from and giving an ABC corrective wave up before continuing down. So we're starting to outline the actual patterns of the market, as you see here. So you have your 5 ABC or an A to B, C to D relationship. It's essentially the same thing, and I marked that because when I first started understanding this, I couldn't figure out when somebody said ABC versus an A to B, C to D relationship, and I'm showing you it's basically the same. And we're taking those same swings, if you look here, same swings, okay, see that? And we're drawing that in. So we're taking the X, A, B, C, D, where here you don't see it, right? But now you see it, now you don't. So your X, A, B, C, D forms that Gartley type of pattern. You see? It forms that pattern where just 2 slides ago, I didn't see anything. But the Elliott people saw it. But the Harmonic people saw it also. So essentially, you have your X, A to B, C to D, or X, A, B, C, D relationship, and your Gartley pattern is structured here, as we mentioned. You have your particular patterns all lined up, and your XAB is a 618, your XAD is a 786, your ABC is a 382 to 886, and your BCD, which is your BCD, is a I'm sorry, your ABC up is your 382 to 886 from here, and also your BCD is this right here, your extension. I'm sorry about that. Next, let's start drawing in the levels. As you see, from X down to A, you have a 786 retracement, a 618 right here actually. All right, so you have your 786, 618, and then you have your BCD 1272 to 162 extension. We start putting in your targets. Your targets are typically 38 and 61% for the 2 targets, and your stop loss goes above the swing high. That's how I typically trade. The reason why is because this can come up to an 886 and get what they call a bat pattern or a modified pattern of Gartley or bat, where it can come past that 886 right in the zone and then turn down. So you always want to have it above the X. Keep yourself safe. Downside targets, 38, 618, and then 100%. You start drawing in other market geometry. So you're taking the swing high to swing low, and now you have your 886 to 100%. You see how this is starting to all come together? We're starting to add other factors. This swing down here, up a 1272 to 141 extension. We're taking all the different swings. If you start to notice, we have this swing up here, A to B plus a B to C, and you're starting to get other things that come into play. So we're taking this A to B, and we're from the A to B. It's not going to see it's an extension from the A to B, a 113, a 1272. So if this A to B was 10, this would be 13 or 11 and a half, and this would be 12 and a half. I'm sorry about that. And then we're also looking at the A to B, C to D. So if 10 points up, this would be 10 points. But you also have derivatives of that 100%. 707 or 786, 886, and you're starting to see things line up on a horizontal level. You're taking your highs, your lows, other swings, not just the basic Gartley. You see, we're adding to it. We're creating a XABCD pattern with commonality zones, an area where you would say, I can see resistance. I can see it right here. Here's multiple levels coming together, and this is identifying an area that you want to take serious in terms of a shorting opportunity. You also want to look at time. If we take into consideration, time, we start taking the X to A, X to B, and then we start taking all these others, A to C, B to C, and working out these vertical levels. And as you see in the zone, you draw up this little square box, and that's what we teach on a day-to-day basis. This is what we look at when we're doing our work for our live trading room, for our webinars. This is what we work. We get detailed in time and price so that the end user, you as the end user, can understand what we're doing and understand how to use price and time efficiently using harmonic, using Gartley, using price patterns, using prior swing highs, swing lows. And this is a proper way to look at the markets and a high odds pattern that I could feel comfortable. A basic Gartley pattern itself, easy to fail. Okay, remember I said earlier, a lot of these people that are out there trading, teaching this stuff, that they talking just on the surface level of a Gartley pattern. That's easy. The hard part is finding all the multiple swings and levels and time zones within that to identify exactly where price, where time should find it, but yet you're staying within the confines of Elliott, in the confines of Dow theory, on the confines of harmonic waves or derivatives of harmonic waves. Again, Bryce Gilmore said, if there's enough binding geometry, a pattern will work. Here's another example. We have an XABCD up. Not pretty, but yet you see these multiple levels, these multiple zones that come in this whole commonality area, not to get into the time side, but you can see how this all works. And a lot of times you'll see that A to C is equal to X to D. That same, because everything works in terms of boxes. I'm not going to get into that in this particular webinar. That's another time and date, but something to definitely keep notice of. Harmonic patterns, price geometry all work in symmetry together. Here's another example of a market that exploded. You have your swing lows, your swing highs, and you have all your commonality levels down here that we looked at, be it your swing highs, your relationships, your projections. You have little extensions here, 1 to 2, 3 to another one, and they all project down this swing, this swing, this swing, retracements, and they all cluster up together. And when we look at the market, when they push into these zones, we look at this where support can come in for a buy, and would have put our support, our risk well below the swing low in case of some excess noise. And then if you draw in the pattern, you start to look at, is it a bat pattern? You follow? These are different harmonic patterns tied in with market geometry, tied in with these alternate waves, these Elliott, your high to low, and they give you these possibly these 3 waves down, these multiple waves down. Even though they overlap, you're still getting sequences to the downside. Other things that we teach over at iMarkets Live, swing highs, swing lows, importance of looking at this. There's other derivatives. There's the butterfly pattern. There's the bat pattern. That was similar to the one we just looked at. See that? See that right there? Almost. Okay. Crab pattern. There's the basically derivatives, what we call an XABC, where C is higher than A, and D is below B. I know there's people that have one particular name for it and they think they invented it, but Bryce Gilmore himself, the pioneer in this stuff, invented this back in the 90s and spoke about it and taught about it in the 90s. The only thing was there was other people that came out with derivatives. The Scott Carneys and Larry Presaventos came out with these other fancy names, but they never put a name to it. So just basically all of them are XABC pattern, ABCD patterns as you see here. All right, it's just different derivatives and again, market geometry and binding. So the 3-drive pattern also is that 5-wave. That's something else you may see in the industry. My former partner and mentor, Linda Rashke, had the book Street Smarts, where she talked about the 3 Indians, that symmetrical move. There's 3 drives. It's all essentially the same. Now, this is concluding our webinar. And check it out. Look at this. This is my actual screen, my trading workstation that I have. I have 8 screens, big screens, plus I have 2 large 27-inch monitors that I'm looking at completely different. I have all sorts of computers, looking at moving averages and geometry and everything. I do not exclude anything. I look at everything. I look at multiple time frames, especially here is a daily chart. Here's what's a weekly chart, a daily chart, a 480-minute, an hourly, little time frames. So when we're teaching in our live trading room, we could switch from chart to show our members so they don't have to go in and look at all this stuff. And the positive thing about our signal service members, they don't have to worry about any of this. They just get the signal. Now, I would suggest contact the person who invited you for more information or to take the 14-day test drive. What is our 14-day test drive? Our 14-day test drive is essentially trying out all of our services for 14 days. It's a $1,500 product to test out for 14 days. So you're trying everything out to see if you like it or not. So find out how you can take advantage of that 14-day test drive. Now, I have this video going in multiple formats for webinars. So if there is a link below the video that says take the 14-day test drive, guess what? Take that 14-day test drive. If it's saying learn more about the opportunity or take me someplace else, well then follow the directions, because our education part of our seminar here is complete. I hope you enjoyed learning about market geometry, price action, Elliott wave, harmonics, all into one. And I'm real excited about it, and I hope you benefited in some point. But contact the person who invited you for more information. If it was too fast for you, just rewind it. If you need more information, let us know. We're here to help you. Good luck. Goodbye. My name is Christopher Terry, CEO of iMarkets Live. Thank you very much